The Government Income Revenue Service, GIRS, is introducing new tax brackets for the 2024 tax year to accommodate inflation. This development should be taken seriously as it has the potential to completely reshape the country's capitalist system. The implementation of the new tax code involves utilizing chatbots and automated AI systems to assist the IRS in collecting taxes and identifying individuals who have not fulfilled their financial obligations. These AI technologies will search for patterns and similarities in one's business and lifestyle expenses in order to maximize the amount of taxes owed. Given these changes, having an experienced accountant in 2024 and 2025 will be crucial, particularly for businesses that may draw attention and potentially raise red flags. While wealthy taxpayers typically have strong legal teams to handle audits and other IRS correspondence, the everyday American may not have the resources to fight back. Instead, they may choose to simply pay any fines or fees imposed by the IRS without hiring an accountant or seeking legal advice. The current tax breakdown affects different income brackets. For example, someone earning $75,000 a year would fall under the 22% tax bracket. Even individuals earning as little as $11,000 per year still need to pay a 10% tax. This can be burdensome for individuals who live in states without income tax, such as Florida, Texas, Tennessee, South Dakota, Wyoming, and Nevada. The new tax bill has caused a significant impact on people's net monthly income. Let's break it down. After taxes, the net amount of $40,175 remains. Assuming you're renting a place for $1,500, you also have to cover utilities and Wi-Fi, which amount to approximately $150. On top of that, there's a $100 cell phone bill, $50 per week for gas, totaling $200 per month. The average car payment in America is $729, which adds to the expenses. Car insurance follows at a relatively low cost of $150. Additionally, there's a credit card payment of $300 per month and an average student loan payment of $60. Now let's not forget about food expenses. A usual grocery store trip costs around $50 per week, or $125 per week if you factor in fast food meals. However, realistically speaking, eating out more often would surpass the $125 per week estimate. When you add up all these expenses, the total comes to $4,100 per month if you live in one of the 6 states mentioned. But even if you live in a state like Alabama with a relatively low tax rate of 5%, you would still owe around $312 per month. Therefore, if you reside in Alabama, you would save $533 at the end of the month. On the other hand, for those living in one of the 6 states with 0% taxes, such as Texas, the savings would amount to $775 per month. However, it's important to note that these numbers assume that the cost of living doesn't continue to rise. Considering a yearly income of $75,000, this leaves little room for spending on additional items such as clothes, vacations, or eating out. Saving approximately $700 to $800 per month becomes the priority. But what does this mean in the grand scheme of things? My prediction is that this new tax code will put pressure on small businesses and lead to increased scrutiny on matters like PPE loans and stimulus packages from the past couple of years. Consequently, we'll likely witness a surge in tax-related issues among the population. According to the latest quarterly report on household debt and credit, total household debt rose by 1.3% to reach $17.29 trillion in the third quarter of 2023. This increase was driven by various debt types, with mortgage balances at $12.14 trillion, credit card balances at $1.08 trillion, student loan balances at $1.6 trillion, auto loan balances at $1.6 trillion, and other balances, including retail credit cards and other consumer loans, remaining relatively flat at $0.53 trillion. However, delinquency transition rates increased for most debt types, except for student loans. This could be attributed to student loans being paused during this period. It is concerning to note that credit card defaults were at 9.5% just before the global financial crisis, GFC, in 2008. Currently, credit card defaults stand at 9.4%, indicating a similar level of vulnerability. The auto loan crisis is also a significant concern. Cox Automotive, a leading auto organization, predicts that 1.5 million cars will be repossessed in 2023, an increase of 300,000 compared to the previous year. With the impending impact of student loan repayments, next year's projections are even more worrisome. The student loan crisis is not receiving enough attention, despite its magnitude. 2 out of 3 Americans do not have $400 in savings, and with an average monthly payment of $460, millions of people will struggle to meet their student loan obligations. Late payments and charge-offs will inevitably result in significant negative impacts on individuals' credit reports. Starting from January 1st, after the 90-day mark, millions of individuals will experience delinquencies and various credit issues due to the financial strain incurred during the holiday season. These accumulating problems, combined with the liquidity crunch, credit crunch, and impending tax crisis, paint a grim picture for America's financial stability. The need for money and liquidity is becoming increasingly apparent as people search for ways to access funds. Credit card balances hit another record during the third quarter of 2023, reaching an all-time high of $1.08 trillion. This information, recently released by the Federal Reserve, highlights the growing reliance on credit and emphasizes the urgent need to address the underlying issues causing this economic vulnerability. The balances of various financial indicators have seen a significant increase of 40% since the first quarter of 2021. However, instead of viewing this as a cause for concern, I believe it presents an opportunity. It is crucial to take this opportunity to consult with an accountant, make wise investment decisions, ensure appropriate tax deductions, and establish a solid financial structure. By doing so, you can proactively address this issue and stay one step ahead. It is essential not to follow the crowd and overlook these financial challenges until they become unmanageable. By confronting them head-on, you can position yourself ahead of potential problems. In the near future, I anticipate a liquidity crisis and tighter credit availability. Therefore, it is crucial to have access to funds and secure appropriate tax deductions. Engaging a reliable and knowledgeable accountant would be a prudent investment of time and money. I would like to hear your thoughts on this situation. Are you of the opinion that we are heading towards a period of intensive audits and a different kind of American capitalism? Let's discuss this matter further.